In this video, we'll go through talking about financial statement analysis. We'll talk briefly about the statements themselves and then move into looking at different categories of ratios and how we utilize those to measure performance, to measure efficiency and effectiveness in management's financial decisions for a company. So there are four basic statements that we could look at: balance sheet, income statement, statement of cash flows, and the statement of stockholders' equity. All of these statements are obviously incorporated into any accounting course that you may ever take. But let's take a brief look at some of the parts. The balance sheet has something referred to as the balance sheet identity. Sometimes it's called the accounting equation. The assets, the things on the left side of a balance sheet, equals the liabilities and stockholder equity on the right side of the balance sheet. Now, let's define these, because I think when you're looking at performance, there's a different way of approaching these items. What do they actually tell us about the company? So the assets represent things that the company owns. These are things that they've purchased in order to run the company. They're the cash, inventory, plant and equipment. It includes things like goodwill, intangible assets. All of these things are owned by the company and are used to perform the business. The right side of the balance sheet, the other two items, merely represent where the money came from to buy those assets. So essentially, money comes from one of two places. It either comes from borrowing from the liabilities of the company, or it comes from shareholders, from the ownership, stockholder equity in the company. So liabilities represents what the company owes, right? Where did they get the money to buy the assets? They borrowed some. Stockholder equity then represents the difference between assets and liabilities, but essentially it represents the investment in the company by the owners of the company. Well, how do they invest? Well, the stockholder equity, the book value of equity itself, is just the book value of the assets minus the book value of liabilities. Now, of course, this could be negative. Of course, that would be very bad for the company. It could be negative. But the challenge with this book value of equity number is that the assets, again, the actual value of those assets might not be reflected in book value. For instance, real estate typically appreciates in value, but at the same time, buildings, etc., we tend to depreciate for accounting purposes. The market value of equity, or the market capitalization, is just the market price of the stock times the number of shares that are outstanding. Again, this number, both numbers are positive, so it can never be negative, and it often will differ substantially from book value. So if we look quickly at a balance sheet, you can see that the right-hand side of the balance sheet, in this case the upper side, is the assets. This is what the company owns. Looking down below, we find the debt section. In this case, for this very first year, 2013, there's $6,950 in total debt, and there's $15,580 in total liabilities. Well, if you take the liabilities, the total liabilities, that's total assets, subtract out the $6,950, that then tells us what the equity of the company is. And of course, equity for a company comes from two places. managers buy stock, and owners buy stock, and the profits of the company, some are distributed and some are reinvested. So retained earnings represents money, represents ownership in the company that has been reinvested for shareholders. So we have a company has 3.6 million shares. They're trading at $14. The question is, what is market capitalization, right? And how does that compare to the book value of a company? Well, the global capitalization, again, is 3.6 million times $14, says that this company has $50.4 million in market capitalization. Now, we don't have the financial statements here. They're in a textbook. But essentially what they're telling us is the book value is $22.2 million. We would expect that the market value of the company is greater than the book value. So in other words, what they're saying is we're willing to pay over 2 times more in price what the company is worth in accounting standards. So this is the market price to the book value of the company. And there is a better ratio for that. In this example, we have 5 million shares. The market price is $108. The book value of equity is $50 million. The question, what is market capitalization and what is the market to book ratio? So the market to book ratio here is $9.80. Where do we get that? Well, we need to know the market capitalization, $490 million, divided by the book value of $50 per share, gives us this $9.80. So who determines market price? And I guess that's kind of a starting point for trying to understand the performance measures that we're going to be looking at for companies. Market price is determined by supply and demand of the company's stock. If demand is increasing, that means stock price is increasing. Stock price increases when investors are optimistic, when they're interested in buying the company, when demand for stock is growing. If companies are doing good things, that is what we would expect to happen. So in this case, $9.80 means that these investors are willing to pay almost 10 times the value in accounting terms for the purchase of ownership in this company. And we'll talk about this in later videos. The income statement, obviously the statement for many different terms for this. Really, what we want to focus on here, again, since we're talking about performance, we want to focus on a different way of looking at this. I prefer to think about profit as a measure of control. Gross profit measures how well managers control the expenses of production. Operating profit measures control business operations. Earnings before taxes looks at running of the company, including financing charges. And then net income looks at the overall control of the expenses. So if we look at an income statement and think about control, I mean, in general, if you look at gross profit here, and again, looking at these absolute numbers is not really a good thing to do. But as you look across here, it tells us how well are they controlling. Out of 4.2 million, 1.66 is still left after we pay for production. Out of 11 million, 4.7 million is left. So we almost tripled the size of revenues and about tripled the size of gross profit. So these things might seem to be in line. So again, we're looking for control items as we review and think about the income statement. Now, the statement of cash flows is a very important question. It looks at and tries to reconcile some of the differences within the company. And in particular, what we're talking about are non-cash expenses, right? The non-cash expenses are things like depreciation and amortization. So what we want to think about, right, is where is the money being spent for the company? Well, management essentially makes three kinds of decisions. They make decisions on running the company. So there was a section of the statement of cash flows that shows cash from operating expenses. There is a section that represents cash from investing opportunities. We buy things, we sell things. We see that cash number. Financing activities, we pay debt, we pay interest. We buy and sell stock, we borrow and pay off debt. So these are the three primary decisions that we've talked about in the past. How do we control operations? How do we control investing? And how do we control financing? The thing that tells me how well I do is the cash that's generated from those activities. And again, we can look at how this boils down. And as you can see, the net change in cash from the line item is just cash from operations. Add that to the cash from investing. Add that to the cash from financing. Add those three things together, and that is the net change in cash for the company. Now, in this statement, depreciation and dividends are part of another line. So this 340,000 here, or 340.8, is part of this line up here. Likewise, the 234.6 is part of the cash from financing. So the reason for this is it makes some of the formulas for ratios a little bit easier to copy and to input as you're thinking about doing financial analysis. So what is the impact of depreciation on cash flow? Again, suppose a company has another $8 million in depreciation and their tax bracket is the 21st percentile. What impact does this have on earnings? Well, an $8 million depreciation is going to reduce profits. So it's going to reduce profits, right? So $8 million is the subtraction, but we also get then to reduce, part of that goes to reducing taxes. So the change in income is obviously going to be negative because we increase the expense, means we're going to decrease expenses. You take 1 minus the tax rate, gives us 8 times 8 million, means in this case, we're going to expense $8 million, but in reality, it only costs us $6.32 million. Why? Because the other $1.68 million is going to reduce our tax bill. When you add those two things together, that's the $8 million expense. So expenses are essentially kind of subsidized by taxes. You actually pay a bill, but because it's an expense, you actually reduce the taxes that are due. The final view or statement that we can look at is to say, look, how does equity change? How are these statements all connected? So the change in stockholder equity, you start with retained earnings. You add any sale of stock. That then obviously equals, we have net income. You subtract out dividends, add the sales of stock, and subtract the repurchase of stock. So again, we we have some challenges with understanding exactly how the money gets into equity. And of course, you'll find this when we actually look at annual reports and look at those equity statements. So where do we find more information if we want it? If you have an annual report, then there are two things that give us information about the construction of statements. Management discussion and analysis gives us a blow-by-blow description, if you will, of what management thinks happened to the financial statements. They'll go down almost line by line what they think caused the issues or is giving them value, if it's a good thing, on the financial statements. The notes to financial statements give us information about the accounting, right? Well, how did they determine interest expense was this? Well, they'll list all of the debt and the coupons on the debt. They'll multiply that all out, and when they add that up, that should be the interest that goes to debt. So again, this is where we can find more information. So Apple has this information, right? They have reported the following sales. Here's the different areas of the world that Apple works in. And from 2017 to 2018, there obviously were some changes. So the question is, which operating segment had the largest percent change, and which one had the largest dollar change? So let's think about this. What about percent change? And I'm going to flip back and forth here, at least for a couple of these. In the Americas, in 2018, we had $112,000 here. This is in millions. If you divide that by the previous year's number of 96.6, if you divide those two numbers and subtract 1, that'll give you a decimal, which we could then convert to percentage. So in Americas, it was 16,000. Europe was 13.6. China was 16%. Japan increased 22.6. And again, since you can see that Japan has the highest percentage, I mean, the question might be, if this is where all the revenues are coming from, should we put more money into Japan? Or should we put more money into Europe so that we can build it up? So the question in the end is, how do we do this, right? How do we make this decision? I mean, if you look at the dollar change, you see that Japan is actually very small. So we have a percentage change in USA, but it's a big dollar amount. So I guess the question is, how do you analyze percentages, right? Would you rather have 10% of $1,000 or 10% of $1 million? So in this case, the 22% is a big increase in Japan, but it's such a small dollar amount of the rest of the business. I don't think flooding the Japan market with these Apple products is maybe the best thing to do to increase overall revenue. So I'll talk to you with the next video.